Well, thank you very much for that. That's very nice. Nice welcome. Wonderful to be back in New York. Always nice to be in New York. And it's a pleasure and an honor, actually, to be speaking to the Canada-U.S. Securities Summit, which it sounds as grand as it should be. And where else would you do that except in New York, right? So the year 2016 has gotten off to kind of a rough start. Plenty of financial market volatility. And of course, there's no shortage of things to worry about. Fundamental things, actually, not just little things. There's been another downgrade to the outlook for the world economy. There's uncertainty about that economic transition in China, the pace of normalization in the US, worries about Europe, worries about Japan. That's just to cite a few. Financial markets, of course, have a love-hate relationship with volatility. Central bankers usually try to see through it all. But one worry I hear a lot these days is pretty close to home. And that's the idea that monetary policy just isn't working anymore. So that's one thing I'd like to dispel right off the top. Now, the fact is that policy actions, both monetary and fiscal, taken in the wake of the global financial crisis, prevented what would have been a second Great Depression. Many of the negative forces that were acting then are still acting now. And that's why ultra-low interest rates are not causing rapid growth and inflation. Now, if you think that monetary policy isn't working, ask yourself what would happen if interest rates suddenly returned to 3 or 4%. I think most would agree that such a move would trigger a recession. And that's just another way of saying that the severe headwinds are still acting on our economies years after the crisis, and low interest rates are keeping them at bay. It's a bit like riding a bicycle up a steep hill. Now, your progress may be slow, but that doesn't mean your legs aren't working hard or that your bicycle is broken. Now, monetary medicine hasn't cured everything, but it is working, and it has surely saved us from the worst. But still, as central bankers, we need to take market anxiety and the volatility that it creates seriously, regardless of the source. And although volatility can go both ways, market volatility is usually code for market declines, isn't it? And that can erode consumer and business confidence and cause a weakening in economic fundamentals. So what I'd like to do today is to address another current source of anxiety in financial markets. That's the striking weakness of international trade. After all, and as mentioned by the ambassador, international trade is the lifeblood of the global economy. Firms, consumers, and investors alike all rely on a trade to keep the economy growing, create the jobs, sustain the jobs, and deliver investment returns. Now, the exchange of goods and services has been happening as long as people have been able to produce more than they needed to survive, which left them free to follow other pursuits. An expanding exchange into the international arena is just the next logical step, and that's exactly how global history has unfolded. So trade is a grand facilitator that permits people and firms to specialize and innovate. The resulting improvement in living standards continues until trade reaches a balance point in the economy where all advantages have been exploited. And that balance holds until circumstances change and people react to new opportunities. So given the central importance of trade, it's not surprising that investors are worried about what the recent data show. So for roughly 20 years before the financial crisis, global trade had been expanding by more than 7% year on year. It was growing about twice as fast as the world economy, twice as fast as the world economy. When you think about that, it almost sounds like there's something wrong with the arithmetic. And in fact, trade collapsed in the wake of the crisis, and then it rebounded sharply in 2010, reassuringly. But then, since that time, trade growth has again slowed dramatically, and today it trails even the tepid pace of global GDP growth. So what's behind this slump in trade? Has the link between trade and economic growth changed? Is the trade slowdown a warning of another global recession, as some would say? And if trade is central to the productivity and efficiency of companies, what does the slowdown in trade mean for productivity growth? So I hope to shed some light on these issues today and help everybody better understand the forces that are at work. So let's dig into the data a little. The post-crisis slump in international trade was initially concentrated among advanced economies, particularly in Europe. More recently, though, the trade slowdown has been centered in the emerging markets of Asia, especially China. And this has led many investors to link the weak trade to the slowdown in China, and therefore in the global economy. Well, recent work at the Bank of Canada and elsewhere shows that about half of the slowdown in trade growth among advanced economies in the post-crisis period can indeed be explained by weak economic activity, especially sluggish business investment. And throughout that period, companies were dealing with high levels of uncertainty about the prospects for the global economy, in some cases because of aggressive deleveraging. Now, this has held back investment, and we all know this. And in turn, that contributes to soft trade. That's because investment spending involves capital equipment with inputs from many countries, and therefore is very trade intensive. So when economic growth slows because of weak investment, trade slows disproportionately. So while advanced economies were dealing with the worst of the crisis, China's economy continued to expand. And this supported the demand for commodities and kept a portion of international trade flows moving. Higher prices for commodities also prompted commodity producers to make big investments and ramp up supply. Ultimately, though, growth in China began to moderate to a more sustainable pace. And more importantly, the Chinese economy has begun to shift away from investment-driven growth toward consumption, especially of services. And quite simply, this has meant less international trade. But even so, China's imports of many commodities continue to grow today at double-digit rates. So we have reasons to expect global trade to grow more slowly than in the past. First, because global investment spending is in a lull, and second, because China's economy is restructuring toward more domestic consumption and less trade. We can certainly expect global trade to pick up when the world economy gets back onto a self-sustaining track with stronger business investment. Still, as I just noted, cyclical factors can really only explain about half of the trade slowdown. So we have some more explaining to do. Indeed, I think we need to step back and consider the possibility that the rapid pace of trade growth that prevailed for roughly the 2 decades before the crisis was the exception and not the rule. Now, why would I say that? Well, what we saw during the 1990s and 2000s was the result of the natural incentive to use trade to increase specialization in reaction to reduced trade barriers and major advances in communication and transportation technology. During those years, countries formed regional trading blocs through arrangements such as NAFTA and the European Union. And previously closed economies, such as China, became more engaged by joining the WTO. Well, this combination of elements gave the natural incentive to trade a great deal more room to grow. It paved the way for companies to build global supply chains. We call that the integrative trade model. A factory that made a product no longer needed to be next door to the product's designers. Firms could now exploit their comparative advantage by specializing not just in one particular good or one particular service, but in one part of a good or service. And the result was an explosion of specialization as markets became truly global and companies became much more efficient. Now, as the Peterson Institute for International Economics put it in its recent persuasive report, Reality Check for the Global Economy, quote, trade boomed during the 1990s and early 2000s, in part because intermediate goods began globetrotting. But any trend that goes on for 15 or 20 years becomes ingrained in our expectations. We should have realized all along that this process of integration simply could not continue at the same pace forever. At some point, trade would reach a new balance point in the global economy where firms had built optimal supply chains that crossed international borders, slowing the integration process, at least for the present. Of course, there are other structural reasons you can point to for the deceleration of global trade. A troubling number of protectionist measures have been put in place since the crisis, for example. But I believe that the most important structural factor behind the slowdown in trade growth is that the big opportunities for increased international integration have been largely exploited. China can join the WTO only once. Now, that's not to say that further integration waves won't happen, and I certainly hope that they will. But if global trade has reached a new balance point, we should not fret that global export growth hasn't recovered to pre-crisis levels. Even so, we need to think about what this assessment of the state of global trade means for productivity. Now, productivity matters to all of us because its growth, along with growth of labor, determines the potential growth rate of an economy. We already know that demographic forces are leading to slower labor input growth in most advanced economies. But productivity growth is also slowing, and this combination points to lower global economic growth in the future. And there's more. Now, the most important input into the equilibrium real rate of interest, this is what economists refer to as the neutral rate, is the underlying growth in economic potential. So investors are only beginning to come to grips with the implications of this downward drift in the neutral rate of interest and what it means for long-term investment returns. Now, obviously, it matters a great deal whether productivity growth is likely to remain low or recover as the world economy gains traction. And that depends on how you explain slowing productivity growth. Now, some have said that productivity growth is slow today because most of the truly important inventions happened years ago. Today's technological progress is more incremental. But I think a more natural place to look is at international trade, because companies that use trade to increase specialization also increase their productivity. And if that process has reached a natural limit, at least for now, then perhaps that also limits future productivity gains. A quick comparison of experiences in the US and Canada illustrates my point. So let's look at US and Canadian manufacturing over the past 60 years. In 1955, which by the way I consider to be a vintage year, roughly 1/3 of the workforce in both countries was employed in manufacturing. Now, as is well documented, these shares have been declining, as they have in all advanced economies, as companies built global supply chains and shifted activities to places that can produce the same goods or parts of goods at a lower cost. Last year, the share of the workforce involved in manufacturing was below 10% in both Canada and the US. The US figure a bit lower than the Canadian. Now, of course, today's factories are much more productive than those in 1955. In fact, US manufacturing is almost 7 times more productive than it was 60 years ago. 7 times. Canadian factories are roughly 5 times more productive. Now, both 5 times and 7 times, those are big numbers. But what can explain the difference? Now, the relative size of our economies may be a factor, since there are clearly more opportunities for economies of scale and scope in the larger US economy. But also consider this. Over the same 60-year period, the importance of international trade to the US economy more than tripled, while the importance of trade for Canada only doubled. Now, here I'm measuring the importance of trade by looking at total trade, exports plus imports, as a share of the economy. Now, one explanation for this difference is that Canada has always been dependent on trade. We were founded on a resource export model, and since trade started out being very important for us, there's less room for its importance to grow. But in my opinion, the basic insight here is that US firms pursued globalization and offshoring more than Canadian ones did, boosting the importance of trade to the US economy more than was done in Canada. And when a company procures one slice of its value chain offshore, it does so, to reduce costs. But the result is that the average productivity of the domestic operation goes up. Now, this isn't a productivity miracle, it's just arithmetic. U.S. firms are more likely to be larger than Canadian firms, and that means they tend to have more of these outsourcing opportunities. Smaller Canadian firms are more likely to be part of the global supply chain of a multinational firm and have fewer opportunities to build an integrative trade supply chain. And of course, if you're in a resource extraction business, there may be few opportunities to outsource anyway. Ultimately, the integrative trade model is a powerful force for advancing living standards, and we can see evidence of it in action everywhere. Most of us have examples in the mobile phones we're carrying in our pockets right now. It's true, of course, that the globalization of supply chains has required economic adjustments. These adjustments, of course, can be painful for individuals, and it's incumbent on policymakers to help buffer that transition by ensuring adequate safety nets for workers and facilitating retraining and relocation. But the benefits overall of integrative trade shouldn't be ignored. It has meant increasing incomes for economies and has made many products much more widely accessible to more people, and it has meant continued job growth at home. Now, my argument is that a significant part of the strong productivity performance in the 2 decades before the crisis was due to globalization, and that the globalization process may have brought trade in the global economy to a new balancing point. So understanding this is one thing. The question is, what can be done about it? Now, I see at least 3 reasons to hope for future progress. The first is that a lot of productivity growth comes not from existing firms, who tend to be incremental about it, but it comes from new firms. A new firm with a new product or new service tends to see giant leaps in productivity as it goes from being a startup to the hockey stick growth phase. You knew I'd get the word hockey in there somewhere. A firm only makes that transition once, but an economy can reap the benefit over and over if there's a strong trend in new firm creation. Now, an expanding economy generally sees a steady growth in the population of companies. Under the surface, of course, there's a steady rate of firm exit as well. That's Schumpeter's process of creative destruction in action. So let me just point out that the growth of the population of companies slowed dramatically in a number of countries in the wake of the global financial crisis. No surprise there. Now, I've been watching the Canadian and US data very closely because I'd interpret the emergence of firm creation as a strong sign that growth had become self-sustaining. In the Canadian data, firm population growth has picked up, but it remains slow at around 1% annually, and that's well below the pre-crisis rates. But in the US, there's been a steady acceleration of firm population growth since 2011. And the most recent figures are approaching 3% annual growth in the population of firms, which is right back to pre-crisis levels. Now, if I'm right, that means the US economy is due for another period of better productivity growth. And I have every reason to think that Canada will follow once we work through our adjustment to lower resource prices. Now, a reversal of the cyclical slowdown in investment that I mentioned earlier would also serve to support future growth in productivity. A second reason, I think, for optimism about productivity is that even if most major economies have exploited most available opportunities for international integration, gains may still be had from improvements to existing supply chains. Economies evolve over time, and comparative advantages are not set in stone. Now, consider China, for example, which for years was the main destination for outsourced production. Today, its working-age population is shrinking. Unit labor costs have been rising quickly as the economy moves up the value chain. Now we're seeing signs that labor-intensive production is shifting out of China and into nearby economies such as Cambodia and Vietnam. All of this suggests that companies and investors may be able to find ways to improve the efficiency of supply chains in many geographic areas. And this will show up as a new wave of integration and global trade growth. For policymakers, of course, that means we should be working to help initiatives such as the Trans-Pacific Partnership, the Canada-EU Trade Agreement, become reality. The third reason to be hopeful is that nobody can predict the future disruptive technologies that would allow the global economy to take its next giant step forward. History gives us no reason to be pessimistic with respect to future technological progress. Now, before I wrap up, let me just make one more point. International trade, as measured by our standard global trade statistics, is not the only way for companies to exploit integration opportunities. Some companies find it more sensible to operate foreign affiliates in other countries while managing them from home. For some firms, this model effectively acts as a substitute for international trade. And this business model has been growing, even while traditional exports and imports have been slowing. And we know that sales today by Canadian-owned foreign affiliates today exceed total exports from Canada. It's now approaching 30% of our GDP. In other words, these foreign affiliates are almost like another Canadian economy out there, supporting jobs in Canada in areas such as R&D, engineering, design, and marketing, not to mention the lawyers, accountants, and executives who manage the operation from home. Now, in the U.S., foreign affiliates are even more important than they are to Canada, with sales from those foreign affiliates operating abroad equaling more than 40% of U.S. GDP. So this is a very real sign that companies are growing, becoming more productive, and creating jobs at home, whatever the official trade data show. So it's time to conclude. In a world full of anxiety, my goal today was to give investors one less thing to worry about. Most of the cyclical part of the slowdown in trade should be reversed as the global economy recovers, even if that is a slow process. Further, there are opportunities for progress on the structural side in terms of both trade and productivity if conditions permit another wave of global integration. And moreover, the creation of brand new firms could be the most promising source of new trade and productivity growth. So I hope I've convinced you that the global economy can continue to recover, even if global trade growth remains lower than its pre-crisis levels. The weakness in trade that we've seen is not a warning of an impending recession. Rather, I see it as a sign that trade has reached a new balance point in the global economy and one that we have the ability to nudge forward. As for monetary policy, the Bank of Canada will continue to work on building a positive economic environment for investors, firms, and consumers. We know that sound, clearly communicated monetary policy can facilitate trade, productivity, and economic growth. And that's good for everybody. Thank you very much.
Just stay here, Governor Poloz,
Yep.
because we have a question and answer period coming up. But Governor, on behalf of the IAC, my SIFMA colleagues, and everybody in the room, I want to thank you for having accepted our invitation to be with us this morning. First of all, thank you for your stewardship of Canada's monetary policy, with the courage to shift policy really contrary to conventional wisdom in late 2014 in Canada, and then to manage policy so effectively through a very, very difficult period. Secondly, it's refreshing to hear a really sound rationale for the advantages of international trade. The subject of international trade is so critical to the health of an open economy like Canada, but increasingly so to the United States. And as you said in your public remarks in Ottawa last week, increased international trade through the removal of trade barriers is critical to greater productivity and stronger economic growth, particularly given limited scope for monetary policy and because of a pervasive reluctance for some countries to engage in stimulative fiscal policy. So we've heard those remarks echoed here again this morning. And we are so grateful for you to outline the importance of international trade flows and their impact on economic growth, on productivity, and particularly on future growth in the global economy. So again, Governor, thank you so much. Now I want to open up the floor to questions and answers. The Governor's kindly agreed to take some questions, and and I will moderate the questions. So if you do have one, raise your hand. If you don't, I'll ask the first question, and then we'll move on. But I'd like to give the audience the first opportunity. Anybody have a question? Yes, Mary.
Given that monetary policy is working and is necessary and is around, do you have a timetable in mind of when the easing could justify to be lessened? And then the second part of the question is, with monetary policy being where it is, there's an impact on pensions and rates of return, and given the age of our society, at what point do you think that might become problematic?
Okay, well, I mean, the answer to the first question is nobody actually knows. We think that the pressures of deleveraging and the weight of the experience that we've been through has made people reluctant to spend, to invest. You know, that's not true everywhere, but it's true on average globally. And in that setting, monetary policy continues to kind of push against it to try and prevent those headwinds from knocking us back into a recession or worse. And I think that even when the economy gets up to what we'd call full speed and capacity, which we think for Canada would be, you know, we're almost getting, we're going to get up to full speed this year. It'll take us another full year and probably a year and a half to use up our excess capacity, and arguably longer, because we'll begin to reverse some of the legacy effects of this long cycle. For example, there's like 120,000 people between the age of 15 and 25 who have withdrawn from the workforce, discouraged workers. We're pretty sure they have not taken early retirement. And so it's obviously really good to be able to have the conditions where they get drawn back in. So that's new supply, you know, merging them with new companies will give you more capacity to grow, more, and that's what's happening in the U.S. In the past year, labor force participation has gone up a lot, so the unemployment rate stays constant even though you've had good growth in jobs. So we're not at that sweet spot yet, but anyway, that's a bit of an aside. But the point is that we're not sure when you reach that point what interest rates will be, because we believe there's a good chance that those things will still be pushing against us. So that's why economists say the neutral rate, which would be the rate that would prevail, rate of interest that would prevail once we get there, is unknown, but it's almost certainly lower than we used to think it would be. It's lower because we'll have lower labor force growth and a slower growth trend in the world. Potential growth in the world has been downgraded to about 3.2%. Long-term trend used to be 4%. Okay, so that downgrade means that the neutral rate of interest will be lower for sure for a very long time. But it could be even lower than that if the headwinds are still pushing against us. If those headwinds convert into positive forces, such as when animal spirits flip over and begin to turn positive, then you could get interest rates kind of more normal levels. But it's an unpredictable process. So that leads to your second question. They're linked very closely, and that is that those in the pension business need to get used to it. They need to adapt to it. Because even if interest rates get to a more normal level over the next, say 4 years from now or sometime like that, everything has worked itself out, maybe longer, because who thought it would be 8 years after the crisis and we'd still be talking about this. It's a very slow process. So whenever interest rates get to a more normal level, they're still going to be lower than we thought of them before, because the baby boom, that 50-year period of high growth in labor force participation, high growth, and therefore high neutral interest rates, well, that's behind us. So I don't know how much, we don't have numbers for all this, but you need to be scenario testing those pension plans and the needs of your clients, because the returns simply won't be there. And real assets, people who buy real assets, will need to get used to a lower hurdle rate in order to actually succeed in collecting those assets. Somebody else has already figured it out. It's going to buy a bit higher for that asset. So,
any other questions?
Don't want to put you off your day, but
There's a question up here, the lady right here. Microphone.
Board of Directors, AGF Investment excuse me.
Okay.
Kathleen Camilli, Board of Directors, AGF Investment Management and
Hi.
Universe Corporation. Good morning. Thank you for your remarks. You didn't talk at all about tax policy. I wonder if you could, what the research at the Bank of Canada, what are the latest insights about tax policy between our two countries and its impact on trade?
Well, that's quite a question. I don't know the first thing about it. So what's the next question?
We got somebody with
No, I'm sorry. I mean, I don't want to treat your question frivolously, but I really have nothing to offer you on that. Sorry.
someone there.
Yeah.
Governor. So in terms of, you said that monetary policy is still effective,
Yes.
but the experience we've had in Europe and Japan with negative interest rates, with getting the outcomes going the wrong way in terms of stock markets down and currency stronger. And there's kind of a school of thought out there that says, would you take the risk-free asset and turn it negative, i.e. a guaranteed loss, that strange things do happen.
Yeah.
Would you think, at least where monetary policy is extremely diminished in its effectiveness, and would that make the Bank of Canada less likely to pursue a negative interest rate policy if things don't work out as planned?
Well, I would just invert your question a little bit. I mean, it's absolutely clear that monetary policy begins to lose its ability to have an impact the lower interest rates go. So the difference between 1% and 0.5% is not anything like the difference between 3% and 2.5% in terms of the stimulative effect. So it's kind of a nonlinear thing, and economists have always believed that. We never really tested it out until now. Back in the wake of the crisis, when we laid out our post-crisis toolbox, we in Canada believed that 0.25 was truly the technical bottom for interest rates. But now what we realized is that other countries have been, forced, I would say, to at least explore negative interest rates, and have seen their money markets work, continue to function. It's not actually, in general, crept into the consumer space or the retail space. It's generally a wholesale phenomenon. But it has had the effect of lowering the rest of the yield curve, which is really what is trying to be done. So that's the same thing you're trying to do with forward guidance or with QE. You're just trying to bring the rest of the yield curve down flatter. And so you're trying to maximize whatever stimulus you can provide. It's not saying that it's some magic bullet, and no one likes the idea. But if the job isn't done, and you're basically the only entity that's trying to make it happen, you have to use every tool in your toolbox, regardless of how ineffective ultimately they may be. And experience is showing that we are having effects out there. They aren't large ones. And it's why I've said that you're in the neighborhood with interest rates so low, where in fact fiscal policy tends to have its biggest impact. And that's been known since the mid-1930s when Keynes wrote that. It's in our textbooks our whole lives that that's true. And the reason it has bigger impact is because when you have excess capacity in the economy, you put extra spending out in the economy, there's no reaction from interest rates or any other reaction. Whereas, all you do is get more demand, and you get the multipliers working pretty well as fast or as big as they can be. So that's the kind of situation many of us find ourselves in right now, with excess capacity and with monetary policy really not able to give much more impact. So, in the end, we work all the tools in the toolbox until the job is complete. And we're fortunate in Canada that we've had some fiscal action to give us a better balance. And in fact, I would say arguably the same thing is happening in the U.S. The highway bill is a pretty big piece of fiscal spending, which something's adding to the mix. And that's a positive, especially since it's infrastructure, which we hope will increase that trend line. If your potential growth rate is 1.75 or something in the U.S., if it goes up by 0.1 or 0.2 because of infrastructure investment by the government, that's going to give us benefits for a whole generation. year after year. And in Canada, the same thing is underway. Does that answer your question?
Time for one more. Yes.
See, if I drag it out, then there's less questions. But I'm sorry, I didn't intentionally do that.
Hi, it's Grace Shalquick. What would be the impact on the Canadian economy if oil prices stayed low for the foreseeable future?
Well, that is in fact the assumption we work with for our forecast that we have in the Monetary Policy Report just published 2 weeks ago. So basically what we do is we don't forecast oil prices because it seems like it's too hard to do. So we just take the last 6 or 8 weeks, like an average of the most recent period before we deliver our forecast. So our assumption is $40. I think that's for Brent, but anyway, it doesn't matter. So around $40 for Brent or for WTI, and we just assume it stays like that. And Canadian companies have told us that even though that's way better than $27, which we had for a brief time, or in the 30s for quite a while, they said it's not enough to change their minds. That in fact this year they will cut investment spending even further with a persistent $40 price tag. So that's built into our forecast, and so we think that the Canadian economy can kind of give us around 2% growth. It's 1.7 for this year, but accelerating to above 2 for next year, because it's the rest of the economy which is picking up speed. That's led by exports to the United States of all the non-energy goods, and which of course are closely connected to the U.S. recovery, which is clearly in a sustainable place, as I was talking before. And on top of that, we have an exchange rate competitiveness effect, which is putting a little icing on that cake. But it's primarily about the U.S. recovery. It's not so much about an exchange rate story. So all that to say that we think that we can kind of do this transformation internally. The energy sector shrinks as a share of the economy. The rest of the economy picks up. So we have these two tracks. And the export-oriented sector, which is close to 20% of the economy, 17 I think to be exact, is growing at almost 4%. Okay, so but the energy sector is shrinking at a rate of about 4%. The rest of the economy is growing at about 2%. So that's kind of how the tracks are averaging out. Is that honestly the last question?
That is it.
Oh, wow, geez.
Thank you so
Okay.
much.
Yeah, all right. It's a pleasure. Thank you. Thank you. Thanks, Ian.